Hello, everyone. My name is Stephen Meade with Domicile Real Estate. This is our July whole monthly market update for Southern California real estate. So, if you are outside of Southern California, this may not mean a lot to you. If you're within Southern California, though, we'd absolutely love to help you. And this is something that is important for you. Let's go ahead and get started with this. So, the first thing we're going to look at is we're going to look at our active inventory. How many listings do we have? And if you look at this chart, right, we've divided this as we always do between under a million and the 1 to 2 million price range. And this is across LA and Orange counties. And one thing you're going to notice is just how similar this is, but I want to point something out. While the level of inventory is slightly down in the $1 to $2 million category, it is slightly up in the under $1 million category. And there's a very good reason for that. And that's because I think the brunt of what's going on in the market right now, namely interest rates that have bumped up a little bit, as well as a lot of economic uncertainty, I think the brunt of that is being borne by entry-level home buyers. I think that's the group that is both simultaneously has maybe the best opportunities, but also has the highest number of headwinds. So when you look on this chart, inventory is a little bit up in that under $1 million price range. And again, that cuts both ways, right? It's an indication of how tough it is for these entry-level home buyers, but it is also an opportunity as there's more inventory to choose from. So if we also take a look at our last 14 days of new listings, I want to point out something interesting here, and that is in both of these categories, we actually see fewer homes coming to market than we saw last year. Now, in the case of 1 to 2 million, that number had kind of accelerated and then took a little bit of a dive month to month between this month and last month. But you can see that number for under a million, that's generally been weaker this year than it was for almost all of the spring and summer last year. And again, that's really talking about kind of some of that weakness. Now, I'm going to point something out in a second. I'll take a minute to talk about it because I think it's really important to understand why do we have a market that seems like it's stagnating, that's almost unable to move in any direction. Either it can't decide to be an overheated market and it can't really decide to be a market that turns into a buyer's market either. If we look at the flip side, right, of supply, that would be demand, right? How many homes are going into escrow? And we see here that we're actually less than where we were at last year under both categories. So whether you're under $1 million, that number is actually down by a decent amount versus this point last year. And that's really a recent development in the last month or so, right? And then if we look at where are we in for our 1 to 2 million, that is also down a little bit, though down by less. So again, we've got that same narrative going that it is the entry-level home buyers that are really struggling the most right now, even though they ironically have probably the better opportunities. I think the $1 to $2 million market is a bit more competitive right now. I think that entry-level segment, if you're careful in how you choose homes, I think there's a lot of opportunities for buyers in that segment at the moment. So I want to take a minute and I would like to talk about why do we have such a stagnant market? And we've talked about having a stagnant market before, but I think a lot of people don't understand kind of the zone we're in and why this keeps happening, at least here in Southern California. Why is this not a market like Florida, right, that is seeing a bit of a correction? Why is this not a market like Austin? And I think there are a couple things in the Southern California market that are particularly unique that we need to understand. So first off, the phenomena we have is a lot like the steering wheel in your car, right? If you make a right-hand turn and you let go of the steering wheel, it will automatically recenter. And that's not caused by some crazy magic. It's actually engineered into the front suspension of the car to do that as a safety measure. Well, our real estate market is basically behaving the same way. When we have events that throw that steering wheel to the right or over to the left, what we're seeing is there are a number of built-in sort of structural elements of the market that are pushing back. So for example, right now, one of the reasons why we're seeing a stagnating market is because you'll notice that our new escrows are way down, but so is our supply, right? And this is because we've got sellers who see that, oh, there's weakness in the market. Maybe I'll delay in putting my home on the market. So we have a market that is self-reacting, right? So every time you say, well, interest rates, that's going to lower demand, right? And that's going to reduce prices. It never quite ends up happening because supply ends up lowering at the same time. And one of the other things we've got in California is we don't have a lot of new construction supply, right? So in a market like Florida, in a market like Austin, Texas, you've got a lot of home builder activity, right? And those homes are going to come on the market almost no matter what, right? Home builders need to keep building homes to stay afloat. However, in our market, which is, gosh, in LA and Orange counties, I mean, the percentage of new construction to resale, especially in the populated areas, I mean, it's like, it might as well be like 99% to 1%. That new home construction, that market doesn't exist. So we've got a whole bunch of sellers who can decide when to put their homes on the market. And when it looks like there's some softness in the market, they are choosing not to do that at all. And that's stabilizing the market. That's keeping prices steady. So if we go here and we take a look at our absorption rate, you'll notice that number is shockingly similar to where it was last year. Now, things did accelerate at the end of last year, and I think that was caused by a little bit of interest rate relief. We did see that absorption rate go up, but we are back to almost exactly where we were back in July of 2025. And that's right in that kind of like 60% range, which is actually a pretty balanced market. Like that's what we would call a very stable marketplace. I will give a word of caution here. Um, Real estate is a hyper local market, and especially the more the specific type of property you either have to sell or to buy, the more local that market becomes. So, for example, we do a lot of work with architectural and unique properties. That market is inherently much smaller. So, if you have a great listing, I don't care. That home could go on the market December 21st. And if it's a great house, people will show up on Christmas Eve to look at that house and write an offer on it, right? Because that's a very small market. So always understand when you're looking at these stats, how to apply this information to your own situation. So again, if we take a look at our closed prices, right, I think this really tells the story here. If you look across this, I want you to notice something. Almost every single one of these price categories, that 75th percentile, right? We'll call that the higher end of the market, the median end of the market, which is right around $1 million, and then that entry level end of the market, which is $750,000. Look at where we are versus where we were at last year. We are almost identical in price. Very, very small movements year over year. And again, this really speaks to the stability and this kind of self-centering market, right? It's kind of found a groove in the record and it's sort of hard to jump out of that canyon. Everything kind of pushes us back into the groove. Also, if we look at our percent still active after 14 days in the market, right? This number is almost identical to where we were at that last year, though with one very important exception. Last year, this was declining. Now remember, a declining number here means a market that is tightening or getting more competitive. A rising number is a market that is getting less competitive. So this year, we've got a market getting less competitive. If we look at last year, at a market getting a little more competitive, but these are not big changes, right? These are not wild swings that we're seeing in the statistic. If we look at our list to close ratio, right? I think this one really tells that story of two different markets, why this under $1 million market is very different than the $1 to $2 million market. So if you're a buyer or a seller in either of these spaces, this is really important to understand this difference. Typically, you'll notice that these markets move pretty closely together, right? As the market gets hot, we start to see homes going above list price on average. They both have seemed to move together, except for right now. Now, there have been a couple of exceptions to this if you look at the chart, but right now we've got our under 1 million market is noticeably softer, whereas our $1 to $2 million market is sitting just under 100%, meaning sellers and buyers are in pretty close alignment about the pricing of the homes. If we look at our days on market for new contracts, we again kind of see numbers that had previously been very close together, kind of showing some wild divergences, right? And so right now, our days on market for new contracts, these are the homes actually finding buyers, that number is a bit lower for $1 to $2 million homes than it is for under 1 million, just kind of showing again that there is a very big difference in the demand levels and sort of how much each buyer group is maybe struggling with macroeconomic conditions. If we look at our three-way affordability chart, I do want to address something. So a lot of you have spoken to me privately about the gap. That gap that you see in the yellow line, which is our CPI index, that gap is actually from the government shutdown when there was no Bureau of Labor Statistics data coming through. So CPI numbers were not released during that time period, and that's the reason why that area is blank. I want to draw your attention to a couple things with this chart. One is that I know there is a narrative out there in the marketplace that rents are absolutely out of control. Now, in all fairness, this is rents based on median single family. So this is not apartments, this is renting a single family home. And we do that so we can have some comparability to a payment index. But if you look at this, and I think it is important to look at this, notice that since 2018, June of 2018, right, this is over 8 years ago now, where we started our indexing, you'll see that that CPI and that rent index are not wildly different from one another. They both moved up quickly. There was a period of time where they moved real fast, but they've kind of held a similar level of differential, right? So yes, it is more than the CPI index would indicate, but it's not as much more as people think. Now, if we look at our payment index, what do we see there? Well, I think the right way to look at that is to say, well, CPI has gone up maybe 130% here versus June of 2018, but the payment on a median priced home has gone up 190%. Maybe that's the way I would read this and interpret this chart, and a good way to think about it. But what we track that's really careful to understand is this is sort of my canary in the coal mine chart. This is my chart where I try to deduce, are we going on some wild tangent where home prices are unsustainable and the market has just gone stupid crazy? And my answer is no. And the reason why my answer is no is you'll notice that that payment index never really stretches too far from that rental index. And I think that's important because those numbers are related, right? Because if you are a first-time home buyer, you can choose to either rent a home or you could choose to buy a home, right? Like these are very similar type houses and housing. Those numbers bear some relationship to one another over time. And we don't see this getting wildly out of control. And I think that's really sort of what you're looking for if you're trying to predict a market collapse. So our prevailing mortgage rates, this is one that I think shows things maybe aren't as quite as bad as they seem if you read the headlines right. The headlines will tell you that due to the war in Iran, we're pretty much seeing rates the highest they've ever been. Not true. Rates kissed 7% around this time last year, and we're about midway between their bottom and that 7% mark. So yes, they've absolutely come up. You can see in there in March, right? What happened in March? We did have some sort of global economic turmoil occurring, supply chain disruption, Strait of Hormuz, et cetera, et cetera. But that market really hasn't gone to where I think it could be. So, right, this could be a much worse situation than it is. We're still seeing 30-year fixed rates in that kind of 6.5% zone. Anyhow, thank you so much for watching. We're a real estate brokerage here in Southern California. We like to be a lot more strategic when we're helping our clients, trying to figure out what should they do and help them with their real estate decisions. If that sounds like you or someone you know, absolutely, we would love to help you with that. If you're located here in Southern California, and even if you're not, we're happy to make some recommendations as well to agents that think like us. Anyhow, don't forget to like, subscribe, hit that notification bell. Thanks so much for watching, everyone, and we will see you again real soon.